Hey, good morning, everybody. It's Hammer. Today is Wednesday, February 26, 2025. I, of course, am here with the Daily Mortgage Rate Update, the only place on the web where you can join me live each and every weekday morning, 9:30 a.m. Eastern Time, coming to you from Punta Mita, Mexico. Once again, if you're here this morning, say good morning, like my man Tim Kyla. If you are watching the replay, don't forget, just give me a hashtag replay in the comments. Let me know that you were here. That like button, tag, and hello, friend, share this post in a group. Hope y'all are doing well this morning. Good morning, Megan Lindberg, Brandy Brickler, Deb Dickinson, and thank you for the birthday wishes. James Mahan, good morning, sir. Great to see you here as well. Remember that if you would like a quick reminder that I am going live, you can go ahead and sign up for a text message at hmmr.io/reminder, hmmr.io/reminder, or use this cool QR code over here as well. All right, let's go ahead and see who else is here this morning. Angela Walters, good morning. Rob Stewart, great to see you. Ron Siegel, so today is National Pistachio Day, as well as Johnny Cash's birthday. Who's a Johnny Cash fan out there? Let me know in the comments if you're a Johnny Cash fan. I am absolutely a Johnny Cash fan. Good morning. Good morning, Yasmin, and thank you for the belated birthday wishes. Randy Teagle, giddy up, sir. Amy Blauser, good morning. Great to have you here as well. Cindy Pulliam, good morning, and thank you as wishes. So today, National Pistachio Day. I had pistachio ice cream last night with our baklava cheesecake, and today is Johnny Cash's birthday, so welcome to Mr. Johnny Cash. Yeah, Rob Stewart's a big Johnny Cash fan. Who else is a Johnny Cash fan? Ron Siegel walks the line. Good one, Ron. I like that. Yeah, good one. So, in fact, I just learned that my next mastermind group meeting in May that I'm actually here in Mexico with will be in Nashville. And last time my wife and I went to Nashville Museum, and that was pretty cool. So, Nelson Foy, Brandy, who's not a Johnny Cash fan, right? How could you not like Johnny Cash? Thomas Wolf, good morning. Johnny Cash Museum, they had a display of all kinds of artists singing Johnny Cash songs. It was wicked cool. They were all doing covers of Johnny Cash stuff. Just everybody you could think of all different genres and different time periods. It was very, very cool. So very much so. All right, my friends. Well, let's go ahead and get started. Take a look at what we got going on in the news today in the markets and all that. Now, if you remember yesterday, we started to see a big shift in what was going on. And right here, I'm circling mortgage-backed securities. Let's see, I'm just going to look here. We had seen mortgage-backed, and they were testing this 100-day moving average, this green line. And you'll notice these little candlesticks. We had a tough time breaking through that level. But last week, we blew through it. And then the 200-day moving average, which I really did expect to be much harder and get tested more, we blew right through the 200-day moving average. The technicals were not making a difference at all. And we've seen that continue. Now, last week, I was in a position where we talked about locking anything closing near term. We were looking at getting those bounces, probably not seeing a better level from what we had seen earlier in February, which was right around 101.04. But if you'll notice right now, we're at 101.41. And we're testing levels that we've seen back here in December. So we were at 101.50 yesterday. Take a look at this candlestick. Let me zoom in on this. Let's see. We're going to zoom in, right? So if you take a look at this candlestick right here, and let me just see if I can make that go away where it's not. No, it still does it if I do that. This is annoying that it does that until okay. So look at this candlestick right here. Let me shake the mouse so the arrow gets large. And you can see this candlestick went really high, but it came back down. We ended the day still with gains, but not breaking through that 101.50 level. Right now, that's our technical resistance, would be 101.50. Last time we tested that was back here in December. Before that, you can remember back when September, October, when rates were going up, bonds were falling. That was the last time that we saw mortgage bonds testing those levels. So there's a lot of sentiment right now on why we're seeing that, though. So we want to keep an eye on this 10-year Treasury yield. 4.29 is fantastic. Remember that not long ago, we were at 4.55 right over here. This was 4.63. We're at 4.55. So when we take a look there, and now I got to bring this chart back up. There you go. When we take a look here, we have really seen bonds drop down. Right now, here's an article on Bloomberg talking about that, right? So bonds dip on tax cuts while bets build on tariff-driven rally. Option traders wager on Treasury gains as the U.S. economy weakens. Budget blueprint calling for deep tax cuts weigh on bonds. Now, let me put we're going to stop the screen share for a minute. I'm going to go back to that article, but let's get political for a minute, right? What's going to happen is we're going to see a lot of the blame game because the economy is starting to show cracks and traders are starting to see that. Markets are starting to see that. Now, Trump is going to talk about how he inherited this economy and how this is all kind of a thing. We'll see that spin. But markets were thinking that, they kind of just went in with this blind optimism that when Trump came in, that things were the economy was going to take off and, that things are going to continue to get better. And this is more realistic. We know that there's fatigue, there's spending fatigue. Consumers out there spending money they don't have. We know that consumer credit is hitting record levels again. We know, in fact, I read an article in the Wall Street Journal a day or two ago that said that half of consumer spending is from people making above 250 of the population. The earners are spending 50% of the money. And, basically because everyone else is just trying to survive. That's where all the discretionary spending is coming. And that's kind of what people are seeing. And I think that's pretty true on what we see. Now, here's the reality. If we see continued signs of economic weakness and inflation stays in check, we're going to see rates continue to creep a little bit lower. This is your opportunity to grab a couple refis. They're probably going to move higher. We know that sentiment shifts. We know that that trend is going to change, and we want to be ready for that. Last week, I was more concerned that we were going to see those technicals. We talked about locking loans closing in the next couple of weeks just to protect them because we knew that we were going to, what goes up does come down, right? And we had technical resistance levels at play. There was not really any economic data that was making a big deal. Friday's economic data with the ISM data, or I forgot what it was. But anyway, Friday's data was definitely showing economic weakness, but that was really the only thing. Now, this Friday, we're going to get PCE inflation data. We're also, I think it's Thursday, we're going to get the GDP data. So we do have a couple more things going on this week. The PCE data is going to be a bigger one. The consumer price index, the CPI, that one really was pushed higher. A lot of the blame was on things like shelter, auto costs, auto insurance, things like that. We'll see where the PCE comes in. If it comes in more along expectations, whereas the CPI came in a little hot across the board, especially on the core being the important part there. So where are rates going to go from here? We could see them, continue to improve. We want to continue to cautiously float. Let's take a look and see where things are at. I mean, it's a really, really good option right now that we may see things improve. Let me go back. Let's kind of dissect that article a little bit. I have not had a chance to read it in full. Let's take a look at it together. We'll kind of go through it. So treasuries fell slightly on Wednesday amid talks about U.S. tax cuts, even as bond traders start to hedge for a possible economic slowdown by placing wagers on a big market rally taking hold soon. Now, remember, this is the sentiment that we're looking at. It's not the realities that we have to worry about. It's the speculation. And if markets are basically preparing for this is going to help us. But if we see that trend change, if that momentum turns, we have to be ready to lock some loans at that point. But right now, we want to keep floating. Yields rose 1 to 2 basis points across the curve on Wednesday after House Republicans passed a budget blueprint calling for deep tax cuts, which may grow the U.S. deficit by $3 trillion over 10 years. I don't really look too closely at any of this stuff. They always make it over 10 years, but yet administration's only going to be in for 4, and it'll all change. And so, but I don't know. They always broadcast it over 10 years, right? The 10-year rate traded at 4.31. Once again, it's at 4.29 right now. So it's actually gone up just a couple basis points on the morning. We want to see them test that 101.50 mark once again. 101.50 is what we're looking at for technical resistance on these guys right here. But let me see. Where's that article? There we are. All right. Still, U.S. yields very close to the year-to-date lows reached on Tuesday after a rally in treasuries that brought the 10-year down from 4.57 a week ago. Option traders are shifting their positions as the U.S. economy, which is already showing signs of weakness, faces more pressure under Donald Trump's tariffs. Now, that's the idea is that it's funny. They talk about how tariffs are going to build inflation, create inflation, and then that drives bond yields higher. And yet at the same point, we turn around and see it kind of flip the other way. And they talk about that it's going to cause economic weakness. Trump pushing for tariffs to start in March against Canada and Mexico, as well as the ones that were pushed off from February. He says they're planning to take effect on March, but you never know. Again, this may be more posturing, maybe more room for negotiation. There's a risk-off tone as we're performance of the global economy. CMO Capital Markets Ian Lingen, U.S. Treasury bullish wagers Tuesday. Trump confirmed that tariffs Canada and Mexico are set to go into effect next week by saying during an event in Washington 10-year yields should naturally drop with Trump's policy. Now, that's the kind of the mantra that they're sticking with, is that they want to see the yields drop. They want to see rates drop. And they've talked, they haven't really talked about how they're going to make that happen. And there's been speculation on how that'll be forced to happen. One standout position, 10-year drop to 4.15 and beyond, emerged Tuesday morning. If we see that 10-year drop to 4.15, remember right now we're at 4.30-ish. So if we see it drop to 4.15, we would see rate sheets improve. So let's jump over to the rate sheet side. 6.80 according to Mortgage News Daily. Let's take a look at Optimal Blue and see what it says people are locking loans at. You can see, look at this drop in this line right here. Look at how since the middle of February we were really just kind of holding steady, and then we've seen rates really drop right around last week, February 19th, so about a week ago. 6.82 to 6.81 to 6.77, 6.73. Now we're at 6.65. A little bit better than what you're seeing at Mortgage News Daily, but again, for consistency, you can compare the two here. We've just seen rates continuing to chip lower after holding steady for almost the whole month of February. And we think we're going to continue to see the move lower. So for now, I would suggest to continue to cautiously float. If we do lock, we'll only want to be locking things that are closing in the near term. We want to give loans that have time more time, unless we see a very firm movement in sentiment where all of a sudden markets think that all of this is going to go the other way. Right. So be ready for that. That's what we're looking at and where things will go. So good morning, Bill Stevens, Mike Thibault, Mike Morano. Great to have all of you here. Taylor Henry. So again, this is good for rates as far as what kind of counsel are you giving to consumers? Cautiously floating is fine. Floating loans with more time is fine. Do we know where the bottom of this will be? We don't yet. Will rates move that much lower? Probably not. But maybe another eighth, right? Maybe mid sixes, govy stuff in the low to mid sixes. This is one of those windows, though, where when it starts to move, we want to get some loans locked. So start making those more aggressive prospecting calls right now. Get some things lined up. We see an opportunity to take advantage of this kind of a thing. But this could bring us to some of the lower rates, and we'll see. We'll have to see where it goes. In order to see rates continue to move lower through the year, we'd have to see continued economic weakness, maybe some labor market weakness, more talk of the Fed cutting. Right now, expectations are that we'll see 2 Fed rate cuts by the end of the year, possibly a little bit more. Again, as that vacillates, when we see speculation that those rate cuts disappear, that's one of the things that contributes to where we see mortgage rates creep higher. But right now, this is where the sentiment is heading. It's a question of how long will it go in that direction? How low could it go? Will we see signs of more economic weakness? Will that GDP data come in on Thursday showing weakness? It's a revision. We've already gotten the initial findings, so this will be the first revision, and then we'll see the final. So we'll see what those revisions bring, and then what that PCE data brings on Friday. Taylor said, thoughts on how we think PCE will look? I have 2 closings within the 25 to 30 day range. Again, on 25 to 30 days, Taylor, it really depends on their risk tolerance. I don't even like to handicap when it comes to where these reports come in, because it seems like they're never correct, right? If I go with the consensus, then, and I say, hey, this is what I see happening. That's kind of, you never know. I don't really speculate, well, based on this and what fell off and this kind of a thing, because that doesn't seem to work consistently. These reports definitely have a lot of variation to them. So when, heading into that PCE report, it is the Fed's favorite gauge of inflation. But when you put that into the current trend that we're at and the momentum that markets are holding that the Fed is going to cut, it would take a super hot report to cause problems. So I would be, right now, I wouldn't mind floating into that PCE report to see what we get. because even the CPI report, rates were bad for, if you remember, it came in on a Wednesday, rates jumped. Thursday, they started to improve. By Friday, they were actually lower than they were on Wednesday. So even that high CPI report didn't really hurt us for more than a couple of days. The PCE also not going to do that, not going to do any more than that either. So floating into this one is really not truly risky. So definitely keep that. And, so, all right, my friends, well, thank you for joining me. Appreciate y'all being here. And I think tomorrow, I think I have time to come live from here before we go to the airport and travel home. So I will see you one more day tomorrow. So, all right, my friends, have a fantastic one, and I'll see you tomorrow. Bye-bye.